Hi all, today we are going to discuss about shifting and incidence of taxes. Um, it has a traditional concept in the process of taxing. Seligman distinguishes the three concepts. A tax may be imposed on some person, it may be transferred by him to a second person. Sometimes it may be ultimately borne by this second person, or it may be transferred to others by whom it is financially assumed. The next is shifting, the process of transfer of a tax, while its impact lies on the person who pays it at first instance, or shifting is the process through which a taxpayer escapes the burden of a tax. Forward shifting, tax burden from the producer to the consumer in the form of higher price of the commodity. Price serves as the vehicle through which tax is shifted. The next is backward shifting, when the imposition of a tax caused a reduction in the prices paid to the factory owner. Incidence of tax. Incidence is the supplied distribution theory where the focus is on how various tax systems affect returns and commodity prices. A budget has two sides. One is the tax side and the other one is the expenditure side. But concern with the incidence has traditionally focused on the tax side of the picture only. Incidence of taxes, individual case, incidence of commodity taxes, traditional view, the tax constitutes an addition to the cost and prices must increase to cover the rise in cost. Whether the price will increase to enable the firm to shift the tax depends on the nature of the tax, the economic environment under which the tax is levied, and the taxpayers' practice in taking advantage of any possibility of shifting the tax to the other persons. Mm, Shifting and incidence of taxes is proposed to be examined under demand elasticity, how the price rise compares with the size of the tax rise. Price TPTR SS supply curve before any tax levied SSTT, the imposition of tax shifts supply Q curve DR and commodity purchase P commodity purchase at a higher price quantity. It is a highly elastic demand. Uh, Next one is demand elasticity. TP, TT, PT price, SR, SS, QS, QR, DD quantity. Moderately elastic demand. Absolutely inelastic demand. When commodity is produced at constant cost, the relative elasticity of demand exclusively determines the long-term reaction of the price and the imposition of the tax. The key concept is that tax incidence or tax burden does not depend on where the revenue is collected, but on the price elasticity of demand and price elasticity of supply. Mainly, the tax is fixed on the price of the product, but not depend on the whom they are paying the tax to the government. So the government is more concerned about the price of the product. Then sometimes the government will give concession to the to make over that situation, or else in certain situations, or else in certain conditions to safeguard the a citizen of the country. So, shifting the taxes is possible, and also it is comes under the law. with the relevant document. Thank you.